Hello and welcome to this episode of Tax Update. I'm your host Andy Rainford, Chartered Tax Advisor and Content Writer here at Tax Essentials for Advisors. This week there is a crucial change to the mandatory payrolling of benefits, news of a campaign against fraudulent retailers, and a case that looked at travel expenses reimbursed by an umbrella company. The government has revised its plans for mandatory payrolling of benefits in kind by adopting a phased implementation approach from April 2027, rather than requiring all benefits to be payrolled from day one. The first phase will focus on the most commonly provided benefits: company cars, car fuel, vans, van fuel, and employer-provided medical benefits. Most other benefits will follow a year later, from April 2028, while employment-related loans and living accommodation will remain outside the mandatory regime until a future date. The announcement follows extensive feedback from employers, agents, and software developers who raised concerns about the scale of the original proposals. The response has included simplifying the reporting requirements and significantly reducing the number of real-time information data fields needed in the first phase. For employers, the immediate focus should be on reviewing arrangements for company, vehicles, and medical benefits, as these are the areas most likely to be affected from April 2027. While the phased approach is welcome, mandatory payrolling still represents a major change in how benefits are reported and taxed, so preparation should begin well in advance of implementation. The government has announced a renewed crackdown on what it describes as dodgy shops, businesses that are suspected of operating outside the tax system or deliberately underreporting their income. The campaign involves coordinated activity between HMRC and other enforcement agencies, targeting retailers believed to be involved in tax evasion, hidden economy activity, and the suppression of sales. Particular attention is being given to cash-intensive businesses and to the use of electronic sales suppression techniques, where software or systems are used to conceal transactions from accounting records and tax returns. While the language used in the announcement is unusually direct, the underlying message is clear. Reducing the tax gap remains a key government priority, and HMRC is prepared to use both intelligence-led investigations and on-site enforcement activity to achieve that objective. For advisors, this serves as a useful reminder to encourage clients to maintain robust record-keeping and ensure that sales, VAT, and cash handling procedures are fully compliant. Businesses operating in sectors perceived as higher risk should expect increased scrutiny as HMRC continues its compliance drive. HMRC has updated its guidance on the reporting obligations of personal representatives during the administration of an estate. The changes focus on the distinction between formal and informal reporting procedures and follow concerns that earlier guidance had created uncertainty about when a full estate tax return was required. The revised guidance confirms that informal reporting remains available in appropriate circumstances, which will be welcome news for executors and advisors dealing with smaller or less complex estates. Where the relevant conditions are met, this can significantly reduce the administrative burden associated with estate administration. However, the clarification does not remove the underlying obligation to calculate income, gains, and tax liabilities accurately. Personal representatives must still ensure that the correct amount of tax is reported and paid, even where informal procedures are used. For practitioners in the private client sector, the update provides useful certainty and is worth reviewing when advising executors and trustees, particularly in cases where income or gains arise during the administration period. MyPay Limited is an important case for umbrella companies and anyone advising on employment-related travel expenses. The dispute concerned whether workers engaged through an umbrella company were employed continuously between assignments, or whether each assignment represented a separate employment. That distinction is critical because it determines whether a worker is travelling to a temporary workplace, which may qualify for tax relief, or simply commuting to a permanent workplace, which does not. The tribunal found that there was not enough mutuality of obligation between assignments to create a continuing employment relationship. Instead, each assignment was treated as a separate employment. That meant the workers were travelling to permanent workplaces, and the associated travel costs were not deductible for tax or national insurance purposes. The tribunal also rejected an alternative argument based on an HMRC dispensation. For advisors, the case serves as a reminder that the employment structure and contractual arrangements used by umbrella companies remain subject to close scrutiny, and that travel expense relief in this area continues to be a challenging issue. This case examined a recurring issue in owner-managed businesses. Can an individual retain personal goodwill separately from a company through which the business is carried on? Mr. Walters had originally operated a business personally before incorporating it. Some years later, an LLP structure was introduced, and he argued that he transferred his own personal goodwill into the LLP as a capital contribution. The tribunal accepted an important point of principle. Personal goodwill can exist independently of a business entity in the right circumstances. However, the real question is whether such goodwill actually exists on the facts of a particular case. In this instance, the tribunal concluded that the goodwill had effectively passed to the company when the business was incorporated. Clients contracted with the company, the business was conducted through the company, and there was no separate goodwill asset remaining in Mr. Walters' personal ownership. For advisors, the decision is a useful reminder that claims involving personal goodwill will be closely scrutinized. Simply because a business depends heavily on an individual's reputation does not mean that individual owns a separate goodwill asset for tax purposes. And that wraps it up for this week. See you in July for the next instalment.
Thanks, Andy. Don't forget your sun cream if you're out and about this week. If anyone missed it, you can now view our recent webinar on VAT planning via our YouTube channel. Just use the link shown here.